Ladies and gentlemen, good day and welcome to the Q3 FY22-23 earnings conference call of the Karur Vysya Bank. We have with us today the management team of KVB, represented by Mr. Ramesh Babu, MD and CEO, Mr. Natarajan, President and Chief Operating Officer, Mr. Ram Shankar, CFO, and Mr. Srinivasa Rao, Company Secretary and Compliance Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, to take us through the highlights of the quarter gone by, after which we will open the floor for questions. Over to you, sir.
Thank you, ma'am. Good evening to all of you. Welcome to our bank's earning call for the quarter 3 of the financial year 2023. Trust that you, your colleagues and family members are keeping well and in good health. My heartiest New Year greetings and wishes to each and every one of you. I also would like to thank you all for taking time in joining this call. I am pleased to share that for the third consecutive quarter, our performance in terms of growth, profitability, and asset quality are in line with the indications given during our previous interactions. In fact, we have crossed the indicated numbers under some parameters much ahead of the timelines earlier envisaged. While I am sure that all of you have gone through our quarter, period and numbers in our presentation, I would like to brief you on the highlights of our performance. Our ROA continues to improve consistently over the 8 quarters. It has moved upwards by 39 basis points from 0.93% in quarter 3 of the previous financial year to 1.32% in the current quarter, as against our guidance of 1.2% in the exit quarter of 2023. Our concerted efforts in stimulating the various levers of ROA have yielded positive results and enabled us to achieve this parameter well ahead of timelines. We are now confident of reaching ROA of 1.35% in the exit quarter and continue the growth trajectory in the coming years. Operating margins further increased to 4.32% for the quarter and sequentially expanded by 25 basis points. Going forward, our normalized NIM, after adjusting lag effect of assets and liability pricing, would be in the north of 4%, considering our business model and subject to normal market conditions. Fee and other income continues to grow in tune with the business growth. Higher number reported during the current quarter includes an amount of 85 crores accruing from the recoveries made in technically written off accounts. Operating expenses are under effective control and are in tune with our guidance. Thus, implements, higher fee-based income, recoveries in written off accounts, and containment of expenses aided the increase in profitability. PPOP has increased by 72% to 689 crores over last year and sequentially by 20%. During Q3, a provision of 250 crores was made towards NPA book on account of aging as well as to improve our coverage ratio. We have front-loaded some provisions with an aim on optimized balance sheet and tax planning. Hence, even though the credit cost appears slightly elevated at 1.02% during the 9 months of the current year, our credit cost commencing from quarter 1 of the next year will be considerably lower. A provision of 102 crores was made towards SR as per latest RBI guidelines on valuation of SR. With this, the entire outstanding SR book under investments portfolio of 491 crores is fully provided. Our net profit has been consistently growing for the past 8 quarters, and for the current quarter, it is grown by 56% over last year and 67% for the 9 months period, and sequentially by 16%, and the trend will continue to improve on account of increased PPOP, and lower credit cost. Our gross slippages during the quarter continue to be under control at 162 crores and for the 9 months at 345 crores, which is 0.55% of our loan book. Our digital underwriting, eyeballing of proposals by risk team, better valuation methods by technical team, collection setup, and credit monitoring have helped us to keep control on the slippages. During the quarter, we have recovered a sum of 190 crores from NPA book, besides 85 crores from the technically written off accounts. This is the 6th quarter where our recoveries and upgradation other than write-off are higher than gross slippages. Due to lower slippages, better recoveries and technical write-off, our gross NPA is now below 3% and stands at 2.66%. Consequently, and also as a result of optimization measures, our net NPA is now down to 0.89%. Going forward, we intend to keep our gross NPA at below 2% and net NPA at less than 1%. With this, we now confidently say that the asset quality issues faced by us in the past have been successfully surmounted and consigned to history. Incidentally, I would like to recall late Sri Rakesh Jhunjhunwala always asking us, when would the bank reach less than 1% net NPA? Our heartfelt respects to his thoughts and insights. Bank would endeavor to keep this number below 1% of our loan book. We will continue to focus our efforts in early recovery of technically written off accounts. Our SMA 30 plus loan book, including jewel loan, continues to be less than 1% of our loan book. Again, we are confident of keeping this book at below 1% considering our improved monitoring and collection systems. In tune with our guidance, loan book, without considering technical write-off, continues to be inclusive and grew at 16% YOY and sequentially by 3%. As indicated earlier, bank has strategized to grow inclusively at the existing loan mix. Accordingly, we have initiated various measures in the past to reach best possible growth in line with the industry. Unlike in the past, where branches were the only source for growing the loan book, we have now created business banking units, corporate banking units, transaction banking units, NEO, precious metal division, co-lending with NBFCs, etc. Besides, a smart banking group which will be operational from first quarter of the next financial year and fintech tie-ups. It is a mix of our own team supported by outsourced sales force. The smart banking, what I mentioned is, it is a mix of our own team supported by outsourced sales force for the SME business, particularly the CBG business. Now, we are translating these initiatives into business and are going forward, we will be in a position to derive value by scaling up our numbers with better management control. Yield on advances is at 9.04% and has increased by 49 basis points sequentially, and we expect that there will be a further increase of 20 basis points in the fourth quarter. As indicated earlier, about 86% of our loan book is linked to MCLR, EBLR, and we expect that about 38% of our loan book will be repriced on the respective reset period in the coming quarters. Considering the need to grow term deposits, we have activated our operating teams for aggressive marketing efforts supported by increase in deposit rates, campaigns and publicity. We have grown by 18% year on year and 6% sequentially in term deposits. Demand deposits growth continues to be a challenge under the rising interest rate scenario and grown by 6% year on year and muted growth sequentially. As indicated earlier, we have recruited resources from the market having expertise to support our operating team and strengthened our sales force for better sourcing and deepening of liability products. The team has started working with branch channel on acquisition, CASA acquisition particularly, customer engagement and deepening, besides focusing on institutions, government business and task, and will be fully operational from Q1 of 2024. With these changes, we are focusing to take our CASA mix to 40% in the years to come. Cost of deposits increased to 4.26% for the quarter and sequentially increased by 18 basis points. We expect that there will be further increase of 30 basis points in the fourth quarter. Our co-lending business with 3 leading NBFCs is doing well, and we are in the process of rolling out this service to one more NBFC during this quarter. During the quarter, we have implemented microfinance tie-up with a leading fintech in 16 locations covering 2 states. We have also tied up with one more fintech for microfinance in Tamil Nadu and will be operationalized from the first quarter of next year. Our CRAR continues to be comfortable at 17.86. This 9 months profit has not been included there, and the liquidity coverage ratio is maintained at a prudent level of 200%. To conclude, the business numbers indicate that our asset quality issues are an item of the past, slippages are under control, and earnings are improving. Our focus is now oriented towards inclusive growth and recovery from written-off accounts. I am sure the bank is on the right path to maximize value to the investors. Once again, I thank you all for participating in the call. The forum is now open for the questions. Over to you, ma'am.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Rinesh Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir, and congrats on a great set of numbers. So just 2 questions from my side. One is on the commercial banking division. So if we look at the pie chart which we show in the PPT, the share of loans between 10 crore to 25 crore has gone up pretty sharply in last 4 quarters. So sir, what is happening there? I mean, what kind of a customer we are acquiring, from where we are acquiring this customer, and maybe if you can give us the ROA profile of this customer will be helpful, sir.
Yeah, fine. Thanks, Rinesh. One thing is, if you can recollect, 2.5 years back, we have started an initiative called Business Banking Unit, which used to be a part of the CBG. So now what we did is, we have strengthened that. We have provided them the service RMs and business RMs, likewise analysts. All these, what all are required, we have provided them. That's the first thing. And that way, that unit is stabilized. Second thing, what we did earlier, up to last year March, the limit what we have given them is up to 10 crore, up to 15 crore. So 15 crore and above, we were asking the CIG, that is corporate, 15 to 25, we were calling it as a EMCG, emerging market, and we were doing. So now that the BBU has matured and stabilized, from April 1st of this year onwards, what we did, we have shifted that emerging market group to BBU. So that way now BBUs can book business up to 25 crores. So that way, these people, once they matured, they started growing and all. So that growth has come in the BBU. That is the reason for the shift.
Got it, sir. Got it. And
across the country, 15 locations, these BBU outfits are there, and each one they have the relationship managers, sales, service. All of them, they are moving around, and it has become one of the active units for the bank to mobilize the business in that particular segment.
Got it, sir. Got it. So, sir, my next question is on the rating profile of the corporate book. So, sir, when we look at the rating profile as on December, the double B and below book, is still at 30% of the total corporate book. So, sir, what sort of confidence we have that, whatever guidance we are giving in terms of slippage and credit cost, will be able to deliver as per the guidance, and there will be no negative surprise from this 30% corporate book, which is triple B and below.
Good question, Ramesh. You see, in the same table, you start looking at the December 21, where 37 plus 8% comes to 45%.
Right,
December 21 is a 45% is double B and below, and now it has come down to 30%. When it is 45, for the last 6 quarters, we are able to maintain negative slippages. When we have come to 30, don't you feel that we are better off compared to earlier position?
Yes, no, definitely, sir, definitely. So, but
that way, if you look at it, our SMA also, not to say rating profile is one part, but if you look at our SMA also, in general also, otherwise we have been able to put it under control. Because one more thing, what we did is, we have strengthened 6 months back our collections team. And we have a senior executive under collection, and call center we have brought under him. Feet on street we have created their branch channel. Otherwise, earlier on a distributed way, everyone was doing the collections and all. Now we have brought a focus here, and analytics also extensively we are using for predictive modeling, what can go wrong, all these things and all. With this, we are able to bring some sort of a control. And one more thing, what we did is, for last 2 years, we have done enough effort in weeding out where weaker accounts are there. Suppose there was a lot of competition, pressure is there. Whenever these weaker accounts are there, when someone was trying to do it and all, jolly well we were giving it. So that way we could clean up our balance sheet also to some extent at the cost of top line, but we are able to protect our portfolio.
Got it, sir. And just, sir, last question from my side. So, sir, on the ROA thing, what we have said is that our exit ROA will be 1.35 in Q4. But for full year FY24, considering there will be some NIM compression happening in FY24, would one should consider this 1.35 as a new normal, or there will be some, let's say, downward trajectory, maybe 15 basis point in 24?
I feel we'll be able to maintain that 1.35, I feel, Ramesh. Though, in fact, we are yet to do our homework because we are asking. So with the confidence what we have gained over a period of time with these things, we'll be able to maintain that. Not an issue.
Got it, sir. Got it. I have a few more questions, but I'll be back in queue, sir. Thank you very much.
Please. Thanks, Ramesh.
Thank you. We have our next question from the line of Anand Dama from Emkay Global Financial Services. Please go ahead.
Yeah, sir. Thank you for the opportunity. Sir, one is that you talked about your yields will go up by about 20 basis points, that you will benefit from CRR migration. So, what is the outlook on the cost front, and similarly, what will be the impact on the margins that we see for at least next 1 or 2 quarters?
Yeah. So simultaneously, in fact, I mentioned that point. Suppose 20 basis points when we are expecting cost side also, because the time deposits, what all we are booking. Because if you do not book the time deposits, there can be a flight of our CASA to other banks also. So that is the reason we are actually mobilizing and marketing the time deposits. In the process, the cost is going up. So what we feel is maybe during this quarter, there can be a spike of around 30 basis points can be there up to for the deposits and the 20 basis points in the yield. But whatever it is, we feel that so with the yield, with the NIM what all we have, so overall we will be able to maintain a NIM of 4% plus, not of 4% during this quarter. We will be able to manage that one. There should not be an issue.
Great, sir. So secondly is the microfinance book that we have talked about now. So you have tied up with some microfinance institutions. So one, what is the thought process over there? And if you can talk about which is the lending institution that you have tied up with. So whether it will be a more of a, why not going for a BC arrangement rather than going for a lending institution also?
No, I'll tell you, if you look at our overall unsecured book, it is pretty small actually. If you look at it, hardly 500 crores, 550 crores, something like that. We never ventured into this one. But what we understand is Tamil Nadu offers a huge scope for microfinance, and many banks who have come from other states, they are doing very good business here. And we made our own homework also regarding the delinquency, stress levels and all. We found it to be quite reasonable and all. It's a matured microfinance market compared to many other states. So instead of we entering directly into that one, we have entered into a partnership with one of the agencies. It's a BC, more or less like a BC only. As you said, there's a BC arrangement. And what they will do, they will have the setup and combinedly with KBP, they will have the staff, and finally, when the sanction will be through us only. Finally, the end-to-end digital will be working. Once they key in and all, it will come to us, and once we accept the norms, what all we have, it passes through, then only it will be accepted, and we will have a surveillance of these locations. Intention is not to go aggressively in this microfinance, to make a beginning through an established partner who have the better understanding in the area of operation where we are, or in and around our other states that way, so that at least we will be knowing where we are and all what we can do, and progressively to take it forward. Otherwise, it will not be a trust area for the bank. So it's the beginning what we are making with a decent partner who has an experience in this.
But sir, what are the internal capabilities that they're building? Are we hiring somebody laterally who knows microfinance business?
Absolutely. In our agriculture department, we are taking the people to monitor this one. But the other side, the partner whom we have onboarded, they are already dealing with similar arrangement with more than 10 banks for the last 10 years.
But sir, how do you rely on them? Basically, partners would always want to dump some bad portfolio in some other banks, etc. I think what are the internal capabilities that you have? I mean, you said that agriculture department you have capabilities. So these are the old people who have never done microfinance, or you have hired somebody from outside the bank?
No. Actually, currently, the expertise what all in the agriculture, so these people are doing, and we will be taking people also from the market. But what we did is, when we looked at it, the portfolio of the other banks, this partner who is handling, we have seen that. And the question is not the question of any dumping, because it's not a pool purchase from any bank. So afresh we are going to start. When we are going to start also, the districts where we are going to start, in those locations we have seen what the delinquency level of the other banks, what all is there. We have chosen those districts where it is relatively much better, and we spoke to the state government also, because state government has a very good setup for a microfinance. With these things, baby steps we are taking to see how it's going to work.
Because sir, you're spreading yourself too thin, like you are entering into multiple new businesses altogether, and without hiring the people internally, if you get into this business based on the partnership.
This thing, which other thing we have moved into?
Vehicle loan business is also what you are looking at.
No, vehicle loan, I never told also in my inaugural remarks. With vehicle loan, when we are talking, the vehicle loan is a normal four-wheeler, what in the retail segment we do, not the commercial vehicle.
Okay, but sir, I think we need to build. But I think particularly microfinance is a risky business that we have seen what has happened with many other companies, and that is where I think building some internal capabilities is must.
Anand, actually, agree with your point. See, what we are trying to do is, we are not going to scale it in a 3-digit number and all. So what we are trying to do is, because of our digital capabilities, and these two partners, they are also having a very good digital capability. Through API we have connected, and we have created a good digital underwriting model specifically for this, and then we are trying to test it. So it's initially we will test it, and then based on our review, probably we'll scale it further. Because we understand that in Tamil Nadu the delinquency is low and the yields are also better. So some sort of a cream layer is available here. So why not we test it? That is the intention.
Great, sir. So third is like we talked about.
Please be rest assured, we will not go overboard on that. And second point, we are also on the job to internally equip ourselves with the capabilities by taking people from the market. And this absolutely, as I said, it will be only a baby step. We will test the waters and all, then only we will take a call on this. Okay?
Sure, sir. So third, you talked about recovery from some return of accounts. I believe about 4 accounts got recovered this quarter. Is it possible to give some color as to like, are these the loans which have been talked about lately in the ADAC group or somewhere where you have done some recovery in the current quarter?
85.
And is there any pipeline? Is there any pipeline for more recovery in fourth quarter?
Anand, you would have noticed during the past 4-5 quarters, we did some lot of prudential technical write-off. So today the portfolio has become slightly larger, and then we expect the consistent recoveries will be coming from this portfolio. In fact, we have created a separate team exclusively for this, and to see that we are maximizing the value at the earliest possible time. But if you ask specifically many accounts are in the final stage. So some things are matured last quarter, and this quarter also something is definitely it is coming. So like that, many cases, particularly NCLT cases also, it is in the final stages. But we are not able to give any specific numbers and commitment. But going forward, there will be some numbers in this recovery from the technical write-off, Anand.
Okay, sure, sir. Thanks a lot.
Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity and congrats on good set of numbers. So just want to understand, in the opening remarks, you mentioned that you recruited dedicated resources for sourcing liability products. So just want to understand how will they operate differently from what the bank was already doing up till now?
Yeah. Currently, majority of the focus for the liability mobilization is from the branches. The branches, they will be mobilizing the liabilities, making from the existing and the known, or these sort of things. Now, the current revised model, what we are doing, it is absolutely through sales and marketing and feet on street. Entire end-to-end structure we are creating, wherein the feet on street will be there and they will be mobilizing. It can be a state level or territory level. That way, so they will be focusing more on the CASA acquisition as well as the third-party distribution. Everything 360 degree what we can do. So that's what is going to happen. Once they mobilize and bring it and nurture the account for few months or few quarters, after that, the branches will take over those accounts and all. They will do the deepening. Then it becomes an ETB existing to bank customers and all, branches will deepen. In the process, the branches can focus on the existing customers, how to service them, how to engage with them, rather than doing both the jobs of going out and mobilizing and bringing them and within the bank servicing them. So we are bifurcating this. So that way, good resources who have the expertise, we started recruiting them and all. So by the end of March, most probably we will be able to complete a major part of that one. So first week of August onwards, if these two sets in tandem, they will be working. One for the sourcing and nurturing and keeping, and second one deepening. So we can think of having a good traction in the liabilities.
So just to understand, this team will have their KRS primarily on liability origination and will not have any asset targets?
No, asset targets will be incidental to this. Assets as well as the cross-selling we will be doing. So overall, the main focus will be, the hook will be liability. CASA will be the main focus and all. Along with that, the related assets as well as the third party also they will be doing, but the main product will be CASA. Retail assets.
Sure. And
these will be marketing retail assets.
Sure, sir. And these, just to understand, how would the lead generation happen for this? Would it be coming from the existing customers, or how would the lead generation work for them?
Yeah. That is for the existing customers as well as from other sources. That is the reason we are taking this team, the feet on street, including everything from the market. Those who are already in the market, who are established, who knows this methodology and all, those sort of things we are taking. So that way, so they need to hit and run.
Got it. And so second was in terms of the incremental spreads that we will be making on new assets originated and new liabilities originated. If you can share some color on how is that incremental spread right now? If you ignore the back book pricing which is happening on the asset side.
Now, if you look at the repricing of the assets, if you look at it, EBRR, major part of the EBRR hike we are able to pass on. In every segment, more or less, we are able to pass on, excepting few accounts where we will have the pricing pressure and competition will be there, because other things what we are getting from the customer and the relationship also we need to see. So that way, if you look at it, so pricing, currently our EBRR book is around 49% is MCLR.
So sorry to interrupt. So what I was trying to understand is the existing book is repricing because of the VLR, but what I want to understand the new loans that we are originating, are we able to get a similar yields as what is the on-book yields, or that's lower or higher than the existing book yields on the newer loans that we are originating? So just want to get some sense on that.
No, see, new origination, for example, if you take agriculture predominantly jewel loan, it is something around 8.9%. And if it is a commercial, it is more than 10%, 10.1015. And again, the corporate around 9%. So the consumer, it is 9.74%. So like that, it's more or less the matching with our the current yield.
Sure, sir. And sir, lastly, if you look at this slight uptick in the SMA numbers sequentially, so what's driving that? And also, we have seen a 8% sequential increase in the textile loans portfolio. So what is driving this growth in the textile sector? Is it working capital utilization or such functions? Yeah.
No, textile is concerned. For the last 2 quarters, majority of the exposures what we have taken is for the renewable energy. Because few of them, they have gone for solar or the sort of a wind power so that they can save the cost on the power. And depreciation benefit also will be there. Otherwise, if you look at it, the majority of them, they didn't go for any expansion. Our customers, I'm talking, they didn't go for any expansion. That's why term loan book has not grown well under the expansion because they have not gone for that. Second thing also, we need not worry much on the working capital also because many of them, the cotton prices, oscillation, these things are there. The working capital utilization is also relatively low. So it may be 8% is there. The book, these people, they have seen ups and downs over a period of time. So they are reasonably matured in this business. We don't see any much issues out of that. Coming to the SMA book, what you are saying, here and there these sort of things will be happening because few accounts what all were there in the either in the corporate, commercial, these sort of things. So we are, suppose if it's going to flow into that one, we are allowing it to flow. The reason is instead of keeping it and tomorrow having this burden, it is better we do it and all, and over a period of time, if we can recover sooner the better, we'll be able to recover that. So that's why we have allowed a few of the accounts to flow into SMA. So that should not become an issue. Even if something is there, we'll be able to start the resolution process much faster, and it is not a major issue. That's what I feel.
Sure, sir. Thanks. And if I can squeeze in one more question. If you look at last 3 quarters, our annualized slippage run rate has been around 1%. So would it be fair to assume that FY24 we can have slippages below that number? Because GMPs have also come down and the SMA are also under control relatively.
Agreed, but 24 along with the March numbers, once we take stock of whole thing and all, will come back. But ideally, what you said is correct. We'll also aim on those lines, having got this sort of a maturity, both on the collections as well as the quality of the portfolio. We'll also aim for those sort of numbers only.
Sure, sir. Thanks a lot.
Thank you.
Thank you. We have a next question from the line of M.B. Mahesh from Kotak Securities. Go ahead.
Hey, good evening, sir. So just one question. When you are now speaking to your borrowers, if you could just kind of give us a little bit of color on, are they still looking to take more loans? Are they looking to slow down a bit? Just trying to understand what is the general feedback of conversation that you are having with your customers, sir.
Mahesh, I think good question. But this question, it depends on the industry. Suppose few industries where actually the demand is slightly slowed down, so the utilization levels are low. But there are few sectors where actually the demand is there. It can be real estate or construction or these sort of contractors and infrastructure. These sort of things are there. The demand is still there. So that is the reason these people are approaching. So it shifted from maybe textile. Textile, it used to have a lot of demand. Now from textile, it moved to others that way. So once the textile normalcy restores there and all, again the textiles utilization will start. So that way the requests are there, and some requests are coming from the renewable area also, because Tamil Nadu, as you know, it is a hub for this renewables and solar as well as windmills. So those requests are also coming. But trading and these things are concerned. So the demand is there and all, and absolutely we are able to go ahead on those wholesale and retail trading.
Just to extend this, sir, in your understanding, would you be able to accelerate growth from here, or you think that the growth is more or less going to be around the 15% kind of amount?
So what we feel is, let us see, because these current growth rates, whether it will sustain or not for the banking system also. In fact, I have my own this thing and all. So that's the reason this year we thought that let us see 15%. Once budget is out, we will have other indications also. Then we will take a call on the growth path for the next year. But you must be knowing earlier when single digit growth was going on for the bank for 7%, 8% and all. So we could scale it up to 15, 16% now. So that way the opportunities are aplenty. So we will be able to increase it further and we will not miss any opportunity. But it will be too early now to commit for any number beyond 15. But this March we will be able to do it 15 plus. And once budget and these things are out, we will spice up our thinking and all, and we will be able to come back.
Perfect, ma'am. Thanks a lot.
Thank you. We have our next question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity once again, sir. So, sir, my question is on the return of pool, for this quarter. So, 600 crore, what we return off during the quarter in the corporate segment? Is there any couple of big accounts, or let's say these are 10, 15 small accounts put together we have written off?
Not any big account.
There is not a big account, Renish. It's all a number of accounts because it's all prudential provision. And if you notice our net NPA, our corporate is drastically come down. It's only 20 crores.
No, not only that, even gross NPA of corporate, Renish, if you see the slide, it is 102 crores. So that way, not a big account. All big accounts have earlier itself gone. Here, other small accounts, what all are there, it is a optimization and all cleanup process we have completed. Not any big accounts is having issues. Those sort of things are not there.
Got it. And sir, I missed that number from the recovery from the return of account for this quarter.
85 crores.
85 crores. Okay. That's it, sir. Thank you, sir.
Thank you, Renish. Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Jai Mundra from Batliwala and Karani Securities. Please go ahead. Mr. Jai Mundra, please go ahead with your question.
Yeah. Hi, sir. Thanks for the opportunity and congratulations on a great set of numbers. First question is, sir, on your SA growth, right? So while we appreciate that you intend to raise CASA to 40%, but at the same time, the SA growth has been very muted in the last 1-2 quarters. Your card rate has also been one of the lowest. So when you aspire for 40% CASA growth, is there any risk on the pricing also?
I agree, Jay, if you can understand. Thanks for the first compliment. Now, if you look at it, during the COVID, lot of build-up was there for the SA. And once started relaxing and all, people started using either for their business or for the real estate or for investments in the capital market, something like that. People are there in personal consumption. So that way, SA has come down. Now, consciously, we also took a call internally. If we leave the SA like that, when the interest rates in general in the market have gone up, there can be a tendency to move this SA towards the time deposits of other banks also. So that is the reason many of our banks also, who are susceptible for moving this to other banks, so we have moved them to time deposits also so that we can lock in. So this is a transitory phase which can come up. But if you look at our acquisition, what all is happening, new accounts, these things and all, that process is on. Agreed, what you said that 40%, it may look an astronomical number at this stage when the things are pretty difficult now. But with the new setup, what we are planning to do with a feet on street and a full-fledged channel going on, that and all, and we feel that we need to aim for that sort of a number. Maybe pricing here and there, it can be there, but overall, we will look at our NIM, whether we are making money out of this and ROA, all these factors will be kept in mind. Suppose there can be a case, Jai, if pricing here and there, if you are not paying, and if you are not even able to get a resource at all, if you are unable to lend, that will be much more detrimental than not giving a higher pricing. So that way we will see a commercial call will be taken, how much we need to pay, how much we are earning, overall it makes a commercial sense or not. Based on that only we will take a call. Coming to the car also, agreed. So car first quarter we had a good build up and all. Over a period of time it has come down because started using and all. So now with the setup we have created for the task, that also will be fully functional from first quarter of April of next year. So we will be focusing on these tasks, and that way with the government also we have got the permission. So we are hopeful that we need to intensify our efforts under the task segment for the car. So that way both engines, if we start firing, slowly we need to move up. And because 40% when we say that time deposits are also growing, it will be a challenge, but we wish to have that sort of an aim, so that progressively we will move forward. The main hope for us is the new setup what we have created.
Right. Right. Okay. And sir, what would be your deposit growth targets when you target a 15% plus loan growth? Because your LDR ratio is now 80% plus 81%. So how should we look at the deposit growth?
Well, you are right, because when this is more or less the CD ratio is running, so we need to grow hand in hand both deposits and advances together. So that way, so suppose 15% we are planning, more or less deposits also 15-16% we need to plan, then only we will be able to move forward. Here and there excess SLR, lot of SLR is there, we will be able to get out of that, but over a period of time, these two will have to move in tandem. Deposits cannot be much lower than the advances growth rate.
Right. So in continuation, sir, business is growing at more or less 15% plus. But on OPEX side, so far the OPEX growth has been, let's say, very calibrated, 10 to 15% kind of a YOY growth. And in this quarter, I think you would have started providing for bipartite also, and still the staff cost is single digit kind of a growth YOY. And even the other OPEX growth has been barely 10%.
Okay.
So, would you, does this kind of current OPEX growth or current investment would help you to gain, because your business growth aim is around 15%, but OPEX growth is still behind. So, what kind of an OPEX growth one should assume going forward in 24 to help sustain 15% business growth?
OPEX growth, one more thing you need to keep in mind. Last year, because of the family pension, when Reserve Bank of India wanted the banks to provide, they have given a dispensation for the 3 or 4 years or 5 years. We took a call in providing that in 3 quarters. So that way, for each quarter, 27 crores additional provision we have made it. That is not there this year. So that way, if you take it out, OPEX growth will be normalized. That is first thing. And second thing, I fully agree with you. When the operations are growing and our business estimations are also much higher and all, and that too, the teams what we are going to have for the liabilities and all, OPEX cost will be going up. But we are planning in such a way, there can be a lag of 6 months, and initially we may have to spend, the teams will have to come stabilize and they start mobilizing the liabilities. The liabilities what we mobilize will start earning also. So that way the cost what we are going to incur will be offset by the earnings what we are going to have. That is the reason overall the cost to income ratio also we are planning to have around 45 to 47%, which used to be 54 something like that. So that way this quarter it may be an aberration, it has come to 42 odd. Otherwise we will try to maintain between 45 to 47, and there can be a small lag. Investment if you do not make on these sort of initiatives what we are mentioning, over a period of time we will not be able to reap the benefit. So we are not short-sighted as far as the investment and cost is concerned for the next 6 months, but we are looking at the long term where we are going to yield the benefit of it.
Right. No, so just to understand that, sir, what would be a branch expansion and headcount? Because both these things are more or less stagnant. So would you be doing this 15% business growth without adding too much of branches or headcounts, or one should start seeing some traction on the headcount and the branches?
Yes, good question. Now you see, branches, we were opening around 15 branches per annum. So next year we plan to open around 25 branches, and we will go with that particularly, and then over a period of time we will see how to scale it up. Second thing what we are planning is the branches basically they need to mobilize the resources. So the new setup what we are created here, so we are going to have tie-ups with the business correspondents. Currently our business correspondents are around less than 150. So with these tie-ups, if we set up our own business correspondents there, so they will start testing the waters first, and if the business and the liability business is coming up, and they'll also be mobilizing and marketing the retail assets. If these things are coming up, so we can think of opening a branch in that particular location. The cost of operations of a business correspondent is relatively much lower compared to a branch, because there is no fixed cost there. It will be an operational cost, variable cost per transaction we have to pay. So we are planning to go for number of business correspondents in 25 branches, and 3 sets of people will be going up. One on the liability side, as I said, feet on street will go up. Second side for the home loans as well as LAP also, the feet on street we are going to mobilize, and those marketing teams are going to come into place. And third thing, the KVB Smart initiative, we have given a name recently on the SME portion, that is CBG. So we have created a setup under the sub-vertical under the CBG, wherein we are creating the relationship managers feet on street for the SME business. All these will be in addition to the branch channel. There also we will be taking some people. Definitely the staff cost will go up on account of all these three verticals: liabilities and retail assets what we are going to create under the SME. These three are going to have some sort of a cost. As I said, it can have a lag effect also of 6 months, but we will try to even it out during the next year itself by earning. But whatever it is, our intention is to maintain between 45 to 47 with the cost income ratio also.
Right. And last question on OPEX, sir. What would be the wage revision in absolute amount that we would have done for the two months this quarter?
We have done 15 crores, Jay.
For 2 months, right?
No, for 2 months, yeah.
Okay. Secondly, sir, on you have given NIMS guidance, assuming normalized environment going ahead. On your net slippages, sir, right? So for the last 6 quarters, we have been seeing the negative net slippages, and you have utilized the entire thing on bringing down net NPAs. How should one look at the net slippages number going forward? Maybe 1 quarter is still, I think you can still manage, but how should one look at from a, let's say, 4-5 quarter perspective? How should one look at the net slippages number, net of recovery?
Yeah, Jay, in fact, the perspective from now onwards we may have to change, because earlier the recoveries what all are there from the NPAs, and we were looking at the slippages. Because a part has now moved, majority has moved to the write-off bucket. In future, we need to look at the normal recovery from the NPAs as well as the write-off together what all is coming, and the actual slippages. Our intention is still to maintain net negative slippages as far as possible. That is our intention, and we are proceeding on those lines only.
No, good to have those intentions, sir. But I'm saying, do you have the visibility for the next 2-3 quarters, that including TWO recovery?
Yeah, we have a visibility.
Right. Sure. And just last small accounting thing, sir. The tax rate for this quarter looks very low. Is this because of the write-off, and it should not matter for full year perspective, or how should one look at it? I mean, the way we calculate tax rate is around 10% only.
Sure, you are right, Jay. Actually, because of the write-off, some changes happen. Otherwise, if you take the 9 months period and the entire year, it will be normalized.
Right.
For 9 months, just come to 23%. If you see first quarter, almost we had 29% was our effective tax rate, okay? And it was around 28% in Q2. So on an overall basis, same 20% will be maintained.
Sure. Great, sir. Thank you so much, sir, and wish you all the best.
Thank you. Thanks, Jay. Thank you very much.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a question from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi, sir. Thanks a lot for the opportunity, and congratulations on a great operating matrices.
Sir, I just have one question about that. There is one provision on the slide number, I think 29 or 30, where there is an NPI provision of 102 crores. So what does this exactly is for?
Yeah, Pranav, thank you, Pranav. This is simple, Pranav, that is SR. What all balance is there, we had to provide as per the RBI dispensation. That is it.
Right. So that is the same thing that you alluded in the opening remarks.
Yeah, in the inaugural. Yeah, correct, sir. You are right.
Right. So also, can you just explain? Can you just spend 1 minute on what is driving the credit growth currently for you, and will the credit growth continue? Thank you.
Yeah, credit growth, I feel that, so for this quarter, it should not become a problem. Basically, the commercial, if you look at it, so impact is there actually. Many of these smaller units, business banking, as well as up to 25 crores, they are able to get a good traction. That is not a problem at all. And retail is only one thing there. The acquisitions are there. The disbursements are concerned quarter on quarter, more or less happening the same way. But a few prepayments, these things, and few people, those who have money and all, those prepayments have come. And third thing is, last quarter we didn't go for any pool buyout because the pricing, what all has come up in the market, are they repo and all. Few of them are not willing to take it and all. We didn't take it. Otherwise, the inorganic growth also would have been there. So that way, this quarter is concerned, the trend will continue, and we will be able to meet the guidance what we have given.
Right, sir. Thanks a lot, sir.
Thank you. Thanks, Pranav. Thank you.
Thank you. We have our next question from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Could you please indicate on credit costs for the coming quarter Q4 and also for FY24?
Yeah, FY24, it is too early for me. As I said earlier, let the budget be over and all. In the meanwhile, we'll mull over and all. We'll have a clarity on that. Otherwise, Rishikesh, you would have known that for this year, we have given a guidance of around 15%. The growth will be there for the credit, and we will stick to that and all. Maybe 15% plus we will be able to grow. That way, the gap what all is there, so we will be able to do it, and slightly a shade above that we will be able to do for the quarter four. It's the credit cost you are talking. Oh,
yes,
I thought credit growth. Credit cost is concerned, so 1% we have told, but if you can look at it, 1.02 what all is there, so that is majority it has come from the prudential provisioning what we have made. When last 6 quarters our slippages are negative, net slippages are there, the need for providing has literally pretty small, maybe for the aging provision we have to make. So that way we feel that nothing much will be there. Organic credit cost, nothing much will be there. If at all, for the purpose of balance sheet, we have to make because the funds are there, so we may have to do. Otherwise, credit cost is not a worrying factor for this quarter also.
Okay, and for FY24, sir, any indication?
So 24, we will try to maintain between 1 and 0.75, 1 and all. We'll have to work on that once this year is over. So we'll work on that. We will try to be lower than this year.
Okay, that's great. Okay. Thank you.
Yeah.
Thank you very much.
Thank you.
Thank you. We have our next question from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Sir, thanks for the opportunity again. I just want to understand on the provisioning side, since we have accelerated and provided for most of the NPAs, and we have healthy PCR, for the incremental slippages and incremental, like the aging provisioning component on the overall provision will be lower. So for the incremental slippages, will we look to provide as per the RBI regulations, or will we look to accelerate some provisioning on the incremental slippages? Just wanted to understand that.
So, we go with only the IRAC provision norms. Only thing is the prudential provision, instead of making 15%, will provide 40% or 100%. In that way only, it will be underlying accounts will be there for each and every provision we make.
But Rohan, if you look at it, the slide for the NPA, the net NPA of the bank is just 550 crores.
Right.
So that way, so even if here and there something made also, it doesn't make any difference that way, because if it is 5,500 crores, then the question of all these things will come up. The net NPA has come down drastically to 550. So incremental, even if from 50 crores is provided also, it's not going to have much bearing on the bottom line.
No, I agree. So the thought that I was having was that in case you incrementally provide as per the RBI guidelines, probably we could see some drawdown on the PCR reducing and a better profitability and RO expansion. And if you probably choose to maintain a PCR of say 65 to 70%, even on the incremental slippages, to be ready for the Ind AS thing that may come up, then probably the credit cost could be higher, and but then it would be a balance sheet strength that is there on that. So that interview just wanted to understand how it will play out.
I agreed that we cannot take it at this stage because RBI guidelines, what all have come draft paper, they are given time up to 28th of February to study and go ahead. Till such time we have a clarity, we will be going ahead with the IRAC norms only. Once we have some sort of a clarity, what we need to build up and all, a call will be taken at that stage. Otherwise, we will go with the IRAC norms.
Sure, sir. Sure. Thanks a lot.
Thank you, Rohan.
Thank you. We have our last question from the line of Prakhar Agarwal from Elara Capital. Please go ahead.
Yeah, hi sir. Thanks for this opportunity. Just one question and follow up to what last participant asked. We will be submitting our Ind AS pro forma to RBI. Any sort of deviation that you probably see based on the numbers that we have been reporting to RBI if we have to make a transition today?
It's all negligible, not much any big difference we see. Couple of items where there is a gap between our Ind AS and GAAP, but it's all negligible. It's not any big numbers.
Perfect. That answers it. Thanks a lot. Thanks.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, for closing comments. Over to you, sir.
Thank you. I thank you, one and all, for the interest what you have shown in the bank and all, and I wish you all the best in your endeavors. Thank you very much. Thank you.
Thank you. On behalf of the Karur Vysya Bank, that concludes this conference. Thank you for joining us, and you may now disconnect.